What I would like to do is, as Richard said, dive into the markets, see what is trading, what is not, and especially focus a bit on the sentiment, which we are currently seeing in Europe and how that is affecting real estate investment in Central Europe. Firstly, before we really get into the details, on the left-hand side, the breakdown of investment across Europe. As you will all know, very strong focus on core across the continent. The UK and Germany together almost accounting for 50% of the deal flow across EMEA. On the right-hand side, the numbers for CEE, roughly 7 billion, with almost 50% of volume going to Russia, another 1/3 going to Poland, and let's say a small 10% going to the Czech Republic. So extremely polarized, all in all accounting to, let's say, 85% going into 3 countries. The rest, we're speaking roughly about 1.5 billion going into countries like Ukraine, Slovakia, Hungary, Romania. So really very small portions, especially because some big deals in the other portion, let's say, really account for a substance of that. The question now is, how much longer are we expecting this process to take? Is it going to stay like this for much longer, or do we see things happening in the market that really give more liquidity into these, let's say, non-core markets across CEE? There are interesting things happening across the globe, and especially in the US, where we are seeing much more improved sentiment towards Europe. There is a lot of capital raising happening right now. I think that's a trend that started off 4 weeks ago. More liquidity being raised, funds being raised, especially for Southern Europe, so Spain, Italy to some extent, but also Ireland. So let's say the economies that really took a very big hit in Europe. And we believe that this is the start of a process, as long, let's say, as the financial markets are staying as stable as they currently are. That could trigger more investment into, let's say, the non-core locations in CEE as well. But this trend seems to be a bit detached from what is happening in the real economy. The dark green colors indicating the GDP growth, real GDP growth for 2012 on the left-hand side for the let's say for the main CEE countries. On the right-hand side, the main Western European markets. And in lime green, the forecast for 2013. If we focus on the forecast for 2013, it's quite interesting. Let's say there's still quite a lot of negativity in these forecasts. They're all coming down. That's the main conclusion. Russia particularly was expected to grow at around 4% half a year ago. Currently, Oxford is indicating 3%, but in Russia, the expectations are much closer to 2 to 2.5% right now. Czech Republic, Hungary, a quarter ago expected around 0% growth, currently both in negative territory. So this is indicating that the markets, so let's say the real economy is still not growing that strongly. And obviously this is having a negative impact on occupational markets in the region. Moving into, let's say, the investment landscape, I mean, I more or less showed the same picture half a year ago, where the commercial real estate, direct commercial real estate investments across Europe are quite stable, somewhere in between 25 and 30 billion a quarter. So this is mostly equity driven. This was to a large extent obviously debt driven, so the structure of the market really changed. As I said, the expectation is that volumes may go up a bit based on the fact that we are starting to see more value-add money coming into the markets, but this will be a gradual process. The share of CEE in the total European volumes is going up again. So it seems that these cycles are getting shorter. Based on the most recent investment intention survey that Peter Damesek presented at MIPIM, it is still the case that CEE is expected to see considerable deal flow in 2013. Obviously, this is a sentiment-driven survey, but if you look back over the last 2-3 years that we held this survey, it more or less mirrors the amount of money going into the region. So I think this is actually quite a good indication of what investors really would like to do this year. Of course, the trend for CEE is down, but still it's amongst, let's say, the 3 regions we're, let's say, most interested in. What I need to state on this is obviously it's not the case that the higher the bar, the more money is actually flowing into the country, but it indicates, let's say, the amount of investors that are considering investments in these markets. The top picks for Europe clearly are Germany and the UK, and as I said at the first slide, that's roughly 50% of the European market. In terms of what is actually happening in CEE, very strong trading in the last couple of quarters. I think 2013, the start was extremely strong, and the first or second, let's say, strongest quarter since the crisis hit the market. Driven mainly by Central Europe, so Poland, Czech Republic, to some extent Hungary, there was a bit of activity, and particularly in Russia, Moscow. Still, the southeastern European markets, so the Balkans, Romania, Bulgaria, there's very, very limited trading right now. And the trading that is happening is mostly corporate acquisition driven. So retailers buying one retailer buying another retailer. So the structure of the market is a bit different. Maybe one market to highlight, in Hungary, we are seeing more activity in a number of deals, but these deals have a different structure. Generally empty properties, either being office or industrial properties being traded. So that they are not really reflected in these kind of volumes, but we are seeing that the market also there is gaining some traction. Specifically on offices, and then we'll go into retail and industrial in a second. The investment flows in offices have taken a hit a bit after the crisis. Offices are clearly suffering from the fact that we're seeing increased vacancy and considerable pipeline in CEE. And that is a bit of a difference if we're comparing CEE to Western Europe. Generally, everybody is speaking about the lack of finance. That is still, let's say, a trend in the market. However, in CEE, we're seeing actually that it's not that extremely difficult to get some financing. Obviously, you generally need pre-leases, but also more and more we're starting to see speculative development taking place. And this is obviously scaring away investors a bit from the segment. All in all, prime is trading well. Below that, it is getting quite difficult to trade. In terms of retail, generally the conclusion is investors go for really big. And I didn't even include, let's say, the most recent transactions that were concluded, but Morgan Stanley, for example, in Moscow recently acquired an 850 million euro shopping center in Moscow. Another example, Manufaktura acquired by Union Investment in Łódź in Poland, around 400 million. We have the final trading of Złote Tarasy, a very, let's say, well-known scheme in the CBD of Warsaw, close to 500 million. Golden Babylon, the final 50% bought by Immofinanz in Moscow. So this really indicates that investors go for really big. In terms of industrial investment, industrial has been one of the few segments where, let's say, the dip in activity was only short-term. It picked up quite quickly again when markets gained some traction, and this trend is continuing. Don't be mistaken by the fact that 2013 is lower. This is only the first quarter and excludes the deal where probably Ben can comment a bit on later on. So generally, industrial is really wanted right now amongst institutional investors. And also in terms of the share within the total CEE volumes, it's very clear that it's going up almost linear, currently amounting to somewhere in between 15 and 20% of deal flow in CEE. The buyers that are out there, it is, from my point of view, quite interesting to see that Austrians almost, in terms of activity, left the market. They are really focused on reorganizing their portfolios. Share prices have been quite low for some time, and it is clearly affecting, let's say, the deal flow there. The Germans in green, obviously the downward trend affected by the closing for business of a lot of German open-ended funds. Some of the big ones are still active. I already highlighted Union Investment, REEF, DECA. These are still out there and are buying, also in some of the regional Polish markets. And we have some closed-end and special funds that are still active. So it's not the case that all Germans left CEE. UK investors, not a really clear trend, I would say stable around 10%. But what is really interesting is that the US investors are really stepping up their activity, and 2013 is skewed by the Morgan Stanley deal in Russia. But overall, the trend seems to be quite clear. So I already mentioned the US investors are being much more bullish on Europe, and we've seen a similar trend back in 2003 and 2004 when they did quite a lot of acquisitions. So it seems that in terms of timing, the US investors are feeling that this is the time to move back into the markets. And obviously they are also, on the back of the massive quantitative easing that is taking place there, they have some fear for inflation. Russian investors, almost coming from very low levels back in 2004 and 2005, currently around 30% of the market. And there's a change in trend happening. In the past, the Russians tended to be focused on Russia, Ukraine, let's say Eastern Europe only. Slowly but surely the money is coming out of Russia as well. Recently, a large equity fund from Russia bought one of the, let's say, the most core properties in Munich. Really a substantial investment, and we believe that this may come through in the rest of CEE as well. And on top of that, the Russians may start financing more property in Central Europe. So it's not only, let's say, a property investment thing. The expectation is that the role of the Russians across CEE is going to grow. And then you would probably firstly say, well, yeah, this is a bit of a statistical trend. The group of other investors is clearly going down. But the way I would read this line is that, let's say, the small and one-off investors left the region. And therefore, let's say the target group of investors, in case you would like to sell off or purchase, is getting actually more and more clear. So, and also more and more cross-border investors are now really back on the radar again. So that is, I think, a very important trend, what we are seeing now. Some of you may have seen this slide in the past. What I normally indicate here is the spread between the 10-year government bond yield for Germany and the current yields. This green line is the weighted average prime yield for Central Europe. And looking at the spread between these lines, we're speaking about 540 basis point spread. Back in 2002, the spread was 530. So let's say from an institutional investment point of view, it's a very interesting time to move into real estate. Obviously very much driven by low bond yields, but the expectation is that this is the situation that is going to stay for a bit longer. Prime very much in demand. We recently decreased the prime yield for offices in Prague, for example, from 6.5 to 6.25, really based on evidence of trading. So this is on offices. On retail, also quite interesting changes. A bit of a similar line. The gray line indicates the weighted average prime yield for Central European shopping centers. And for the first time in years, the prime shopping center yield went below the office yield. So this really indicates that the weight of money is pushing down the yield there, driven obviously by much higher quality shopping centers available in Central Europe right now. I mentioned Swaty Terasy, but there are more to mention. And then the final slide, and I think this is one of the most interesting ones, the spread between the EU 15 office yield and the Central European logistics or warehouse yield. There is a massive spread between the two. Back in 2004, we almost had 400 basis point spread. Then in 2007, there was only 114 basis point spread. In 2010, it went up to over 300 again, and we're still looking at a spread of around 265 basis points. So this is one of the reasons why currently so much investors are looking into Central European warehouses, combined with the fact that rents are generally very low in the segment. And I think that's something that Ben can comment a bit later on. And again, combined with the fact there's hardly any pipeline on the way. Most of the pipeline is built to suit, so it's not going to influence vacancy rates much. So this, I think, is a very interesting one.